If we're in an earnings recession, where does the stock market grow? Or how does it grow is probably the better word. How does it grow? All right, so fundamentally, my friends, stock prices are contingent on basically two primary things with a third corollary. And we know this from John Bogle, founder of Vanguard. Earnings growth plus dividend yield. Earnings growth plus dividend yield. Now, there's a third corollary, which is called PE ratio, contraction, or appreciation. And we'll talk about that here in just a second. So dividend yield right now is about 1.75, give or take. Maybe it's 1.6, maybe it's 1.8, but it's basically 1.75. That's the dividend yield. So for stocks to grow more than 1.75, that needs to come from the earnings growth. Earnings growth. We don't know what the earnings growth is going to be. We're going to get in that here in just a second. But we do know that right now, the Fed funds rate is 4.75. So what we would need to say is for us to expect stocks to give us at least equal to the Fed funds rate. And we're talking about CDs. You can buy a 2, and probably not 2 year anymore, but 1 year CD, maybe 18 months for 5%. So we would need their earnings growth to be 3% plus a dividend yield of 1.75 to give us that right there. But you need more than 3% because there's no risk in a CD. Basically no risk. But there is risk in stocks. So you're going to need your earnings growth to be significantly higher than 3% to make it worthwhile to invest in stocks for the next year, essentially. Because we're talking annualized basis here. Now the corollary here, and one we don't know, is the price to earnings ratio. So you can get low earnings growth, low dividend yields, but if people are willing to pay more to expand the PE ratio, they're willing to pay $20, $30, $40 for $1 of earnings in the stock market, then all bets are off. We don't need earnings growth so much if people are willing to pay more for $1 of earnings. Those days are gone, man. And people aren't going to be willing to pay more for $1 of earnings when we can get 4 and 5% on short-term money guaranteed. Let me just read you from this book, Ed Chancellor's book, The Price of Time, which I'm very much enjoying, by the way. And he says on page 27, in Of Interest by David Hume. David Hume wrote, no man will accept low profits where he can have high interest. And no man will accept low interest when he can have high profits. So no man will accept low profits when he can have high interest. So right now, if that is true, and earnings, and which I completely agree, and earnings growth plus dividend yield equals rate of return on stocks, plus the corollary of price earnings contraction or appreciation. Well, let me tell you something, my friends. If I can get 4.75 up here in safe money, my PE ratio, I'm not going to pay more for $1 of earnings than historically I would because I can get better returns in safe money, if that makes sense. So to expect PEs, people to pay more for $1 of earnings, that's a stupid assessment because you get higher interest they can have. Unless the profits, the growth is going through the roof. And that's what I want to talk about now. If the growth is going through the roof, people will be willing to pay more for $1 of earnings because they expect to be rewarded in stock prices. That would be the exception to the rule. No man is going to accept low profits if he can have high interest. But we have high interest now. Sadly, we have low profits. Let me show you what I'm talking about. All right, we're in an earnings recession. S&P 500 Q1 2023 earnings are entering an earnings recession. This is on Seeking Alpha, and I love Seeking Alpha. Q1 is expected to mark the second consecutive quarter of negative year-over-year earnings growth, which meets the criteria of an earnings recession. Analysts have set the bar lower heading to earnings seasons by downgrading Q1 estimates. And I'll see how they're like, from a guidance perspective, we have seen 81 negative Q1 earnings per share pre-announcements compared to 26 positives, a 3-to-1 ratio, which is a 4-year high. All right, so earnings 2023 Q1 blended earnings are forecast at a 4.1 billion, which is down 5.2% over the last year. All right, so earnings growth is not up. Earnings growth is down 5.2% year over year. Dividend yield 1.75. So we would expect, and this is just Q1, by the way. So we're only talking Q1. You can't make this annualized necessarily. But for the Q1, where's the growth come from? It's not there. It's going the negative direction. Don't forget to sign up for my locals channel, joshscanlon.locals.com. It's in the doobly-doo. And don't forget to sign my email as well. I will start sending more emails. I enjoy that, actually. They're not hard to do. Just I like doing videos, too. Anyway, so it's in the doobly-doo. Oh, and lastly, I had a guy yesterday say, your videos are taking too long. I think you're losing track. I'm like, dude, most of my videos are under 10 minutes. Do you not know how long my videos were when I first started YouTube? They averaged 25 minutes, dude. I love newbies criticizing you. I think you're losing track and focus, Josh. Like, dude, I've been doing this in my 6th year now. You haven't been around. I can tell you that right now. So you're a newbie. And some guy says, Skippy, you have a hard time taking constructive criticism. So no, just you haven't been here. If you're going to be a newbie and give me constructive criticism, say, hey, I'm new here. Then this probably ain't the place for you, partner, because I don't do short videos. That's not TikTok. All right, so anyway, Q1 is right here. Q1 is expected to mark the second consecutive of negative year-to-year earnings growth, third consecutive quarter of year negative quarter-over-quarter earnings growth, which beats the criteria of an earnings recession. Furthermore, Q1 aggregate earnings have declined by 11.5% from Q2 2022. Q1 aggregate earnings are down 11.5% from Q2 2022. Yeah. The prior earnings recession started in 2020 Q2, which lasted for 3 quarters. Today's earnings recession may also last 3 quarters if analysts' expectations turn out to be correct, with 2023 Q2 earnings growth coming in negative 4%. That'd be 3 consecutive quarters of earnings decline. We're going to be inundated with earnings surprises on the upside. And let me just talk to what that means. We are seeing the early impact of a lower bar set by analysts as we start earnings season. All 20 constituents that have reported Q1 earnings beat analysts' expectations, but they're still negative. They have an earnings surprise on the upside. It's still negative. It's just so you hear, oh my goodness, all 20 constituents that have reported earnings have beat analysts' expectations because analysts have downgraded their earnings expectations. It's still negative. It's kind of like people saying, 2008, I beat the S&P 500. Wow, really? S&P 500 is down 37%. I was only down 34%. Oh, that's great. Okay, so you beat the S&P 500. Wow. All right. Let's keep going here. At a sector level, both energy... Oh, right here. I didn't want to read this. Furthermore, X-energy earnings growth is expected to be negative for the 4th consecutive quarter, surpassing even what happened in 2020. That's X-energy. Energy is up. Now, the price of energy is going down, which is why inflation was down. Why freaking... Oh, I'm trying not to say bad things. But all these people say inflation's going down because of Jerome Powell. No, it's because the energy prices are going down. I will go to my grave so frustrated how many people think the Fed has this little knob to control the economy. Again, it's kind of like the silliness on CO2. If we can just turn the CO2 knob to the left, the temperatures will decline. Oh, it's so freaking stupid, man. It drives me up the wall. People literally think that. Just turn the knob of CO2 and the temperatures will decline. So idiotic. All right, at sector level, both energy and industrials are expected to continue their streak of positive year-over-year earnings growth for 9 consecutive quarters. I wonder why that would be for energy, because Sniffy Joe. Financials are expected to post positive year-over-year earnings this quarter after 4 consecutive quarters of negative growth. That's not enough to overcome the S&P 500, though, because look at this. Estimated Q1 earnings growth rate for the entirety of the S&P 500. Look at that negative. Look at that, dude. It's just dropping off. Earnings growth contribution. 4 sectors have positive earnings while 7 have negative earnings. Yep. Consumer discretionary has the largest positive factor, while healthcare, information technology, materials have the negative ones. Dude, can you not see the trend? Remember, if the trend is your friend, it goes in both directions. It goes on the upside and the downside too, man. The trend is your friend. This is a trend. I mean, it's not just the trend of the stock market prices, it's the trend of the negative prices too, because unlike my man Michael Edison, so I'm a big fan of, we know that Benoit Mandelbrot talks about that the markets do pay attention to yesterday's prices. They're not independent of yesterday. It's not a coin flip. A coin flip, you toss 100 straight heads, the next probability is still going to be 50-50 because a coin has no clue. The coin that is being flipped has no clue what it did last time or last 100 times. It has no clue. It's completely random. The markets don't work like that. They're not random. They do know what they did last time because they're human beings who are deciding the prices of stocks. Let's see here. Some shenanigans on the S&P 500 here. Financials have the largest earnings weight this quarter at 20%, which is 1.5 times greater than its market cap. Why they moved Visa and MasterCard into financials when they were previously in IT. Energy also has a large earnings weight, about twice its market cap. I see that's the kind of stuff that boggles my mind. Conversely, we see the opposite in IT, which has a market cap weight of 26%, but is only expected to deliver 18.5% of the aggregate earnings. So, and it's a little bit of shenanigans. And I'm not saying it's nefarious shenanigans, but it's not a true measure of earnings growth. If you have outweighted, look at the financials, 1.5 times greater this earnings weight than its market cap. Yeah, that's weird. Moderna had the largest downgrade of EPS estimates over the last 60 days, 400%. Sucks, Moderna, you freaking clowns. Moderna, oh, I'm so sad for Moderna. 400% decline in earnings. Let's take a look at what the stock has done. Here's Moderna, $4.49 in September 10th, 2021. You freaking clowns. Now it's at $155. Couldn't happen to a greater group of people there. That's what, I wonder what Pfizer stock's doing. Hold on a second. Let's look at old Pfizer. Hopefully that's doing the same thing. Go here. Not as bad. Let's take a look. That's 58 to 43. Yeah. I hope. I'm trying to be nice. All right, so let's show you something else here. My man Jeff sent this in to me. This is retail sales from the St. Louis Fed. Look at that, negative. When retail sales go negative, a recession usually follows. Look at this, dude. Retail sales, personal consumption expenditures, PCE. That's what drives the economy, retail sales. And they're going negative. Retail sales. Look at that. Now, look at... So they were negative right here at the beginning of this pandemic, and then they spiked up like that. So look, they were negative, what's that, 20%. And they went up to 45%. You remember, if you're down 50%, you got to be up 100% to break even, if that makes sense. All right, so if it's negative 20%, it'd have to be up 33% if memory serves to break even. So you can see here, we pulled a lot of the consumption forward right there. That's a lot higher than the 30%, 33% we need to break even. Isn't that crazy? I think it's, or maybe it's 25%. I think it is. Yeah, if you're down 20%, you got to be up 25% to break even. Something like that. Either way, that's a lot higher. Not good. Now look at this. This is from FactSet, which is pretty interesting. Earnings decline for Q1 2023. The estimated earnings decline was 6.8%. If the 6.8% decline is actual for the quarter, it will mark the largest earnings decline since Q2 2020. On December 30th, the estimated earnings decline for Q1 2023 was 0.3. So we see a significant drop off on their estimated earnings for Q1 2023 and actual. That's nuts, man. Earnings guidance for 78 S&P 500 companies have issued negative earnings guidance, and 28 have issued positive. The forward 12-month PE is 18, but that assumes that the 12-month earnings kick in. Let me show you what I'm talking about. The number of companies issuing negative earnings per share guidance is above the 5-year average. 78 is what they've issued so far, and 57 is the 5-year average, and above the 10-year average is 65. That's significant, man. The number of companies issuing positive earnings per share guidance is below the 5-year average. That's not good. In fact, the first quarter has seen the highest number of S&P 500 companies issuing negative guidance for a quarter since 2019. If 78 is the final number, it will mark the fourth highest number of companies in the S&P 500 since 2006. I came across, this is just Y charts. I'm familiar with Y charts, but this is just weird, man. They said for Q4 2024, the earnings would be $60.26, which is up from September 30th, 2024, which is up from June, which is up from March. So they're. I mean, I want to point something out. This is the weirdest thing I've seen. I was like, why are they doing this? Weird. So they're like right here. S&P 500 earnings estimate is a current level of 60.26, up from 58 last quarter. This isn't true though. I don't know what this is. They're just pulling something out of their butts. It's weird. So look, at the end of December 2022, they expected what they're showing is earnings at 39.61. And yet they're showing earnings grow to 45.07 at the end of Q1. So this is just, I came across it because I initially said, wow, if we're going to get this major increase in earnings from at the end of 53 to 60, I said, that's a pretty significant growth of earnings. I'm freaking positive. But then I said, wait, this is 2024. And then I said, what did they do for 2022 and 2023? Oh, they said 39.61 and then 45. No one is predicting positive earnings for Q1 2023. Yeah, that was just weird. I don't know what that was about. So anyway, anything else? Here's a man, Ed Yardini at Yardini Research here, earnings forecast, and what he's predicting is we're gonna have negative. This is quarter over quarter. Negative earnings for not just this quarter, but next quarter as well. All right, and again, that would be, and then we had Q 2022, Q4, so we'd have 3 consecutive quarters of negative earnings. All right, so that's the issue we have to contend with. We're in an earnings recession. Now, could the stock market have already, is this an interesting thing about the stocks? They're a very good predictor. So is the recession already priced into the market from last year when we had a 20% decline? I don't know, man. I don't think that's that much because a 20% decline in stocks, that's just a drop in the bucket, man. That's my look. That doesn't mean you sell everything. I don't know what to do. I'm in hell's bells. I'm just sitting there. I'm parking. I got a lot of money to save money right now, the money market and things of that nature. I'm just sitting there thinking, again, going back to this right here. If we're in an earning recession, what's going to be the boost that gets us out of that? Consumer expenditures. Where's that going to come from? See, I don't. It's not coming anytime soon. Where's the money going to come from to get people to start spending more? They've already. I'm telling you, man. They've already used it all up right here. I could be wrong, but I'm just sitting there. When that's down 20%, we need to be up 25% to get back to even. And that's up 45%. They spent the money 2 years ago that was supposed to be spent this year. Where is the PCE going to come from? I don't know. The personal consumption expenditures. And that's, again, what drives the economy. Dude, you can see it all over the place, man. There's a tightening going on, which is a leading factor, which is telling you right now that the freaking growth on earnings, again, where's it going to come from? And I'd love to hear your thoughts, man. If I'm wrong, tell me why I'm wrong. Why am I wrong that the market has already priced in, i.e., because we're down 20%, this earnings recession? I don't think so. I think the earnings recession is not just here, because it is, but it's here for at least a couple more earnings. Because where's the money going to come from? Love your thoughts. We'll see you.